We're fascinated by risk. Not necessarily taking risk ourselves, but the thrill of watching other people take chances. We're riveted by base jumpers who fly off cliffs, or traders sweating bullets as they wager everything on the collapse of a market. But guess what? We're all risk takers, much more than we think. In fact, everyone in this room is taking some risk today. Let's start with the biggest risk taker here right now, me. I could blow this completely. I could trip on these heels. But this risk might turn out to be very positive, which is why I and everyone who does a TED Talk steps up on a stage and nervously plows ahead. What about all of you? You could be missing an important call from a client, your spouse, a friend. You could have left your front door unlocked today, or you could have been texting on the drive here. My point is that risk is a constant presence, but we often see it much more clearly when it happens to others. Some people think what I do is risky. I invest money in the stock market. I've managed mutual funds of over $12 billion at a large company, and at the firm I co-founded, we manage over $1 billion in client assets. So what could be pure speculation for some is familiar ground to me. Long before I began to think about risk professionally, I saw it in a personal sense. When I was about 12, I told my mom I had a crush on some boy, and she said, "Whatever you do, don't marry anyone with bad eyes." Well, I wore glasses, but I hated wearing them, resulting in many close calls on busy streets. So I thought my mother was suggesting that my future myopic husband would do the same and get himself killed by passing traffic. Instead, she said, "I know how much you hate to wear your glasses, but if you marry someone who's nearsighted, your kids will be too." So that was a lesson in sensible risk-taking, which is the process of evaluating the range of outcomes from actions we might take and applying a logical framework to manage our response. Why risk my future children's eyesight if I didn't have to? We all experience this kind of lesson, and sometimes we understand what's at stake, and at other times we barely notice. People are aware that the stock market is about risk assessment. Consider that over the past 10 years, on about 1/3 of all trading sessions, the S&P 500 moves up or down more than 1%. That would imply that my partners and I, if we were roughly in line with the market, would make or lose over $10 million of our clients' assets on each of those days. That's a lot of money. The people who survive years of market turmoil develop a risk-reward perspective that allows them to be comfortable in volatile markets. The same can be true for the professional poker player or the heart surgeon, but can this work for anyone facing his or her own individual risks? Not risk-averse, not risk-seeking, but risk-sensible. I would suggest 4 tenets of sensible risk-taking that we might apply to our personal and professional lives. 1, right sizing. 2, right timing. 3, relying on knowledge and experience. And 4, remaining skeptical of promises and projections. These rules might sound obvious, but we frequently ignore them and turn success into failure. Right sizing means making sure that the scope of the uncertainty we face reasonably matches the payoff associated with that risk. So if a friend asked you to invest in her startup, you wouldn't give her all your money. The size of that risk would be too great. Right timing, as it implies, is about understanding that the timing of a risk can impact the outcome. If you're thinking of starting a hedge fund, around an election, the results of which might rock the market, maybe it's better to wait until after the election to launch your fund. The third tenet is to rely on knowledge and experience. The only people who should climb Mount Everest or sail alone across the Atlantic are those who possess those skills. For everyone else, the mortality risk is too high. And the final tenet is to be skeptical of promises and projections. After 35 years in the stock market, I assure you that I have heard every promise of huge upside. The vast majority go unfulfilled. We need to be just as skeptical about extreme optimism as we are about wild pessimism, because the risk of following the crowd cuts both ways. Now we see how we would apply these in a real way in my line of business, which we do all the time. In 2005, from Shanghai to Brooklyn, the construction boom was in full gear. My partners and I wanted to increase the size of our bet to that sector, and we thought the timing was right. So that's tenants 1 and 2. We focused on Harsco Corporation. It was a public company that made scaffolding and platforms. We built an earnings model, and our estimates were so strong that we were skeptical of Wall Street's lower numbers, tenants 3 and 4. Comfortable with our choice, we made Harsco a 3% position across our accounts. After we bought the stock, it began to go up. And in 2006, Harsco climbed 70%. We were thrilled. But as the market went higher, we began to worry about a bubble in the building sector. I was going to Kuwait to see a client, and so I made a side trip to Dubai, where Harsco had a regional office. Dubai was unbelievable. It was a developer's paradise in the desert. It's Las Vegas on steroids. The Harsco team showed me all of their big projects, including the world's tallest building, the 163-floor Burj Dubai. I took this photo from the helicopter. It was mind-boggling. So much so that I began to wonder if this was all too good to be true. Back in Boston, we revised our numbers downward. We had done really well with this sector bet, but now we thought we had seen signs of a bubble, and we wanted to sell the stock before other investors anticipated a downturn, and so we did. In 2008, as we all know, the market crashed. So did the real estate sector, so did Dubai, and Harsco stock collapsed. From its peak in 2007 until late 2016, Harsco fell 75%. During that same period of time, the S&P 500, in contrast, climbed 75%. So the Harsco example is a good case of how to use sensible risk-taking in a stock trade. But you might argue, investments are all about comparing the risks and rewards in dollars and cents. Can we really draw an analogy to our careers, our relationships, or our personal lives? I think we can. If we consider that with investments, we carefully analyze the size, the timing, the information, and the embedded beliefs to determine value. But for key personal decisions, we often avoid analysis because it's too ponderous. Whether it's about taking a remote access job when you really love the camaraderie of the office, or dating somebody who's chronically late, even though you hate tardiness, we often ignore those risks and dangers in our path. Only when we acknowledge them with our eyes wide open can we truly chart a better course for ourselves. I know this well firsthand. Many years ago, when I was 30 and 5 months pregnant, I looked at the ultrasound screen to my left, and I saw not one, but 2 fetuses. So most women who find out that they're having twins when they thought they were having one baby would be excited or surprised. But I already had 2-year-old twins and a full-time job, and I was in complete shock and panic. My poor husband took me immediately to a psychiatrist to calm me down. But I was still an anxious mess days later as I sat on a plane bound for Los Angeles. I recognized the well-coiffed woman walking down the aisle who sat 2 seats from me. But it was not until she pulled out a large folder full of letters that I realized she was the famous advice columnist, Ann Landers. I asked Miss Landers, whose real name was Epi Lederer, if she would please talk to me, because I had a big problem. The size of this risk was enormous. My entire professional life. In terms of timing, I thought my career was over. I knew that in a few months I would have 4 children, 3 and under, including 2 infants, and I was certain that everybody was going to tell me I needed to quit my job and stay at home. Miss Lederer helped me understand the risk factors I faced in a framework that I might even apply in my professional life. From there, I could design a response that would hopefully accommodate everyone in my large family. I saw that it would be a huge risk if I gave up my job because I would be miserable, resent my family, and blame them for ruining my career. So after my maternity leave, I went back to work full-time because part-time was not an option, with a lot of help at home and a commitment to both my job and to keeping my family my top priority. That challenge wasn't easy. In fact, I am sure that the trajectory of my career was flatter than that of many of my peers. But careers are long. And 30 years later, I am grateful that I persevered. So we can all use sensible risk-taking in our personal and professional lives, spending the time to evaluate the uncertainties we face and understanding what lies within our comfort zone will lead to happier outcomes and fewer regrets. Thank you.